We just spoke to Jeff Curry earlier this week. 140 is the target. And so I'm wondering, do we need to not have a recession to get to 140? Or is there a scenario where things are so tight supply-wise in terms of what Russia does for retaliation, for bans and sanctions and price caps, et cetera, that we could even go to 140 with a recession?
I think the key is the timing. Today, the oil market is in deficit, million barrels per day. Even if a recession happens 6 months from now, 3 months from now, the issue we have is critical low inventories today. It's actually not Russia. Flows have rebounded. But demand is still robust. We're seeing supply disruptions elsewhere. So 140 is still our base case because unlike equities, which are anticipatory assets, commodities need to solve for today's mismatch between supply and demand. And again, at record low inventories, what you need is less demand growth before the actual recession happens. Remember 2008, right? During the first 6 months of the recession, oil rallied by 40% because you were still drawing inventories.
So, I mean, I think that's a good point to think about. We're seeing energy spot prices. Equities are, looking to the future. And so could we see a scenario where we hit 140, but then we go to the other end of the spectrum in the case of recession? What's the bear case scenario in your view?
So what's important is to understand the setup, right? We are starting from record low level of inventories, record low level of OPEC spare capacity. We're now roughly 5 years into an underinvestment cycle. So then the question is, how big is your demand shock, right? If it's an 2008 or 2020 type collapse in activities, yes, oil prices can fall sharply. But if we have less imbalances in the system in terms of leverage or financial risk, then the downside then is more moderate, right? I think more $85 Brent would be our forecast under a global GDP outside of China falling to 0%. Now, keep in mind the supply side as well, right? U.S. producers are now very focused on remaining disciplined, returning cash to shareholders. So on signs of weaker prices, weaker demand, we would likely see a slowdown in shale growth as well, which would further help stabilize prices. Now, of course, commodity prices, as we're learning this week, are quite volatile. So in the short run, you could overshoot. But again, this is an environment where we need a decade of investment ahead. We're not at the end of the 2000 investment cycle. That's the key here.